Good morning or good afternoon to each and every one of you. I am Arpita Bedekar, Chief Operating Officer at Fintelekt, and it's my pleasure to welcome you all to this annual review webinar of crypto happenings in 2025, jointly hosted by Fintelekt and the Asian Bankers Association. Joining me is Calvin Koo, crypto expert and special counsel and cross-border disputes and investigations lawyer at Kobre Kim LLP. Calvin is based in Hong Kong. Calvin, welcome to this webinar.
Thank you. Pleasure to be here. Appreciate the invitation again.
Great. Let me tell you all a little bit more about Calvin. I'm sure he's no stranger to Fintech webinars, but Calvin is a New York and Hong Kong dual qualified cross-border litigator. He counsels financial technology clients regarding cryptocurrency related disputes and investigations, as well as victims of fraud on international asset recovery matters. This includes a focus on digital asset tracing and recovery, as well as creative judgment enforcement strategies requiring work in courtrooms and with government authorities around the world. So we are in very qualified hands today for this review. Calvin, it has been another exciting year for crypto, but I think it has been an even more interesting start in 2026. I have to ask you this question that's probably playing on the minds of, many of our attendees. What do you make of this current Bitcoin price trends, and should investors actually be worried about the future of crypto?
Yeah, it's been a dramatic year and a dramatic, 24, 36 hours. As many of you may know, yesterday was Bitcoin's biggest one-day drop since the 2022 crash. So there is lots to think about and talk about as we'll go into more detail in the session today. Just as sort of a disclaimer at the outset, my usual one, the views or financial advice. Yeah, so I was just saying everything I share today is my own view. Nothing should be taken as legal or financial advice, so please consult your own professionals for such advice. But yeah, it's a dramatic drop, but I would say, you might take a couple views, and there's going to be a theme during today's session. So I invite people to think about maybe some of these themes as I discuss it and see maybe where they come out at the end of the session. So I'm going to be talking about increased regulation, increased laws around the world in the crypto space. And there's been a recent history of more institutionalization, meaning institutional money, more traditional financial players coming into the crypto market. So what does that mean when we see like a big drop like this past day or this past week? Well, one view might be well, first, Bitcoin is just one of many tokens and coins that are out there. It is, of course, the biggest one. Maybe it's a move where we can focus in the industry less about the specific rise and fall of a particular token, including Bitcoin, and more of a focus on the actual maturation and development of the underlying technology. So less about speculation, more about the actual tech. That's one view. There's maybe a pessimistic view where this might be an indicator of some renewed crypto winter as of a few years ago. And will the consequences be bigger? A few years ago when there was crypto winter, certainly tremendous negative effect for those in the industry and those that were invested in various crypto tokens or businesses. But the impact on the wider financial markets and the traditional financial markets might have been, smaller relative to the size of the entire traditional financial market. Now, as new money poured in last year, as traditional institutions started building in this space, is there more of an integration such that a negative impact in the crypto sphere creates a much more direct impact on the traditional markets with wider, negative impact? I don't know, to be honest. I don't think anyone can say with any certainty, but that's kind of what we're going to be monitoring over this year. And so see what you think when we at the end of the session. See if you think it's more of a positive story, a negative story. We'll have to see.
Right. As a crypto investor myself, I would like to stay with that optimist theory over there. But before I hand it over to you, Calvin, we'd like to run a quick poll to understand the impact of crypto space amongst our attendees during 2025. Team, can I request you to bring up the poll? So you have the poll here on your screen. Let's give you a few seconds to answer that. Which development had the biggest impact on your organization's crypto risk and compliance approach in 2025? So, Calvin, we'll give them a few seconds and then I will hand it over to you for your presentation.
Yeah, very good. I'm interested in the results.
Okay. There's currently a tie between limited crypto exposure and travel rule. Okay. Let's see which gets ahead. Okay. Can we publish the results now?
Okay.
Right. So the overwhelming view seems to be that they have limited exposure to crypto.
Okay.
And
Interesting. And I
yes,
wonder if we do this again next year, whether the stats will be similar or there'll be a sort of a trend towards a direction.
correct. All right. So, Calvin, over to you. And I'll be here. Once you're done, we can then move on to some questions from the audience. And yeah, you can start.
Great. Let me share some slides. Okay. So thanks again for all of you for joining this session. I'm very happy for the chance to share my annual observations about the state of crypto. And again, thanks to Fintelekt and the ABA for inviting me. So for those who've heard me before, you'll know that I'm coming at this as a lawyer. So I'm not a business or industry analyst, and I'm not necessarily advocating for any particular policy position. But from my practice as a cross-border disputes lawyer, I have to familiarize myself with various issues touching on compliance or criminal and regulatory issues. So through that lens, I have some observations, which I think many in-house legal or compliance, investigations, or government personnel, hopefully find useful for your own work or edification. So last year at this time, a new American administration was taking its first steps in pursuit of a more crypto-friendly policy. And they were ending many regulatory matters against crypto companies and their founders and promising friendlier and clearer laws in the US. That approach helped fuel a bullish attitude in the industry through much of last year, along with continued investment into it from traditional institutions and financial players. This was not just in the US, but it reverberated globally. But by the end of the year, and continuing now through the beginning of this year, again, just as we mentioned earlier, if going by asset prices as one imperfect metric, the value of Bitcoin and other cryptocurrencies came back down, which completely erased those bullish gains from earlier in 2025. Now, as previewed, price isn't the only and maybe not the main relevant metric. Use and adoption continues to grow in terms of the technology, and particularly with stablecoins. Now, legislation and regulation marches on, perhaps even picking up pace as the US policy change has fueled a global legitimization, in a sense, even in the face of concerns about ongoing fraud or sanctions behavior and other illicit behavior. So that brings us to today's session. Today, I want to cover recent developments across three areas. First, the US. As I said last year, part of the reason of focusing on the US is it's had the most dramatic change of policy and approach of any major financial or economic jurisdiction. And just the size of its economy and the capital opportunities it offers affects the globe. So that dramatic change is, of course, because of the new administration in the United States, now 1 year in. So we'll spend a bit of time on this. Second, I want to highlight some new regulatory and legal developments in other parts of the world, including Hong Kong, Japan, South Korea, and the UK. Stablecoins in particular are priority areas in many jurisdictions. And so we'll discuss that and also what's next. My apologies that I can't get to every place. I understand we had over 35 jurisdictions registered for this webinar, but the ones that I'm covering today are among those jurisdictions that tend to be leading the way or perceived to be leading the way in developing laws and regulations this year. So it's likely that those will serve as examples for other jurisdictions that are perhaps still in the process of developing such rules. So I think it's useful to look at what they're doing as a sign of the times. Third, look at what's the latest on global efforts combating criminal activity that's connected to crypto, and similarly, AML regulations. We'll talk a little bit about that. And then we'll end with some thoughts on what to expect in 2026, and then we'll open it up to some Q&A. So please send in those questions. So beginning with the US and taking us back to the Biden era as a starting point for comparison. Now, under the Biden administration, the US securities regulator, the Securities and Exchange Commission, or SEC, pursued regulatory enforcement campaigns based on long-standing traditional securities laws that defendants and industry folks felt were ill-suited for crypto assets. The SEC at that time nevertheless pursued litigation against major centralized crypto exchanges like Coinbase, Kraken, and Binance, and also against issuers like Ripple, and issued suits against other alleged crypto transaction intermediaries that the SEC at that time were saying acted like brokers and dealers, such as by providing wallet services or even market liquidity. The SEC also fought suits brought in courts by the industry, including Coinbase, that had been arguing that the SEC was required to make rules rather than regulate by enforcement. That was a huge criticism against the SEC at the time by the industry. But then Trump was elected in November 2024, took office in January 2025, and things changed. So what did that actually mean in practice? What did the new administration say they would do, and did they follow through in their first year? So if you tuned into this update last year, you may recall I described some policy, law, and regulation announcements, as well as some enforcement priority changes. On the policy, law, and regulation front, 3 days after his inauguration, Trump issued an order that was called Strengthening American Leadership in Digital Financial Technology. Now, included in this order was an aim for, quote, providing regulatory clarity and certainty built on technology-neutral regulations, frameworks that account for emerging technologies, transparent decision-making, and well-defined jurisdictional regulatory boundaries, all of which are essential to supporting a vibrant and inclusive digital economy and innovation in digital assets, permissionless blockchains, and distributed ledger technologies. So basically, that was a laundry list of things that critics of the previous SEC were calling for. The order also put together, or the administration also put together, a working group with a mandate to present the president with regulatory and legislative proposals consistent with that laundry list. The SEC itself created a task force that the aim was to, quote, set the SEC on a sensible regulatory path that respects the bounds of the law. And they were doing that without putting a primary reliance on enforcement actions to regulate crypto. Okay, so that was the idea back in January, February 2025. How did things play out the rest of the year? So on the enforcement side, the administration and SEC followed through very quickly on ending regulation by enforcement. Many of the SEC enforcement cases, outside of those dealing with pure fraud allegations, were cases that were regulatory violations or alleged regulatory violations relating to a failure by a crypto company and its founders to register under the traditional securities laws as, say, an exchange or maybe as a broker-dealer. Again, this was the idea that a lot of these crypto companies should be seen as like a traditional exchange, securities exchange, or a securities broker-dealer. That policy changed, and so by mid-March 2025, the SEC dismissed or agreed in principle to dismiss nearly all non-fraud cases concerning those types of allegations. So I myself, for example, was part of cases that went away all of a sudden. We had been litigating one for a few years, multiple years, against the SEC, only to see that sudden about face early last year and getting a favorable settlement to end those cases. Elsewhere, major cases against Binance, Coinbase, Kraken, and others that I mentioned were all dismissed. Okay, so that's enforcement. Was that actually replaced by clear laws, the type of which were promised? So legislation in the US was passed, but that process remains incomplete. So two important legislative acts at the US national level to cover. Starting with the most current one in the news, the Clarity Act. Now, that was supposed to give the promised clarity about who is regulating what and how. So, for example, is it the SEC that's regulating securities tokens and the Commodities and Futures Trading Commission regulating other types of tokens? How are they doing that? So near the end of last year and through the beginning of this year, this Clarity Act had good momentum. It was passed in the House of Representatives last July. And then having passed the House of Representatives under US lawmaking procedure, it was then going to the other side of Congress, which is called the Senate, for potential markups. Once the House and Senate have a reconciled version, it goes to the president to sign it into law. So right now, the House version passed, and the Senate version was making adjustments, which were at first presumed to then likely be passed by the House and then go on to the president. But recently, it has stalled. So a draft version of the Senate markup of the act was going through a banking subcommittee in the Senate, and it was going through a debate last month when a major crypto exchange publicly voiced their opposition to the new language that was present in that draft. And after they did so, the vote on that version of the markup was postponed. That exchange's opposition was reportedly because of a dispute between that exchange and its supporters against traditional banks over how that act would affect those traditional banks' custodial deposit businesses. So specifically, should crypto exchanges be able to offer users regular payouts for the crypto deposits held on that platform? So often this is framed as a reward, and it would pay a recurring fee of a few percent, say 2, 3, 4, something like that. Traditional banks could view that as effectively akin to interest on bank accounts, right? Right now, many US banks are offering less than 1% interest on many types of accounts, and almost certainly offering far less than the few percent that could be offered by an exchange. So in that scenario, if you're a consumer and you're comparing depositing a fiat US dollars at a traditional bank or a US dollar reference stable coin at a crypto exchange, you might as well choose the exchange. But that has a tremendous negative effect on traditional banks. One estimate is that it could put over 6 trillion with a TR, 6 trillion US dollars in customer deposits at risk by moving it out of traditional banks and into the crypto exchanges. All right, so you can see how that would be a large tension point. Now, the crypto exchange reportedly suggested that banks can compete by just simply raising their interest rates or getting into the stablecoin business themselves. On the other hand, I saw something in the Wall Street Journal where at least one bank, reportedly retorted that the exchange could apply to become a bank and deal with the additional regulations that come with that. So that's where it stands. That's why the progress has stalled on that act. The White House hosted a meeting just earlier this week on Monday, trying to resolve this issue. From what I've seen, there's the usual positive statements that were released, but nothing concrete so far as in terms of a resolution. I should say there are a few other pieces to that Clarity Act, like how the securities regulator and the commodities regulator will collaborate on oversight, including which crypto assets fall under which agency's purview. But most expect that these will be resolved with less drama than the exchange versus traditional bank interest issue that I mentioned. So for example, the chairman of each of those agencies, the SEC and the CFTC, held a joint event on January 29th, already pledging to harmonize global regulatory standards across agencies. So we'll see where the Clarity Act goes. The other key US legislation is the Genius Act. That was signed into law on July 18th, 2025. The Genius Act sets rules for who can issue payment stablecoins in the US. Now, I've mentioned stablecoins a couple times. For those that don't know, payment stablecoins are those that reference a fixed amount of money, often US dollars, with a stable value. And so it's unlike Bitcoin, whose value is going up and down. In theory, a stable coin, the most popular of which are Tether USDT or Circle USDC, it should always be 1-to-1 to the US dollar. So under the Genius Act, these are what payment stablecoins are, and they're not meant to be issued by a central bank or a foreign central bank, not meant to be a security, not meant to be a deposit. So what the Genius Act does is it proscribes reserve and capital requirements, as well as AML standards for stablecoins. So, for example, high level, the reserves must back the coins on a 1-to-1 basis using cash or short-term treasuries, meaning there must be full backing on something traditional for all the coins. And this reserve information, like how the reserves are held, have to be disclosed, including monthly reports examined by an accounting firm and certified by the issuer's top executives. It also requires a clear policy from the issuer that explains to users how they can redeem the coins. So if you have one stable coin and you want to get your traditional money back, it has to be clear how you can do that. In terms of anti-money laundering policy, the issuers are treated very much like financial institutions, and they have to comply with associated AML and sanctions laws. It's illegal then to issue payment stablecoins in the US unless you are a permitted issuer or a registered foreign issuer. So there's procedures for that. It prohibits issuers from paying interest, but it doesn't apply to third parties like exchanges. So this is a distinct issue from that exchange versus traditional banks issue I mentioned a moment ago. In the case of stablecoin issuers, they just can't pay interest. If in the US, issuers can set up either under this federal, meaning national system, or you can also go through an individual state regulator if those states' rules are substantially similar to federal rules. And again, foreign issuers can go into the US if they are subject to a foreign regulatory and supervisory regime, register with the US government, and keep the US customer reserves in a US bank or through some other permitted reciprocal arrangement. So you can see the focus is on making sure, protecting against the downside risk if something goes wrong with the stablecoin and ensuring that US consumers can get their money back. One last legal point in the US, so while it's important to understand these national policies and developments and laws, if you're actually conducting a business there, you have to carefully understand the varying laws of the individual 50 states. There's likely going to be some standard requirements setting a floor, but just like with traditional corporate law, there may be important distinctions across jurisdictions. So given all of that legislation and associated legitimization, in a sense, what's the impact on the business side over the last year? In terms of investment, I saw one report late last year that showed increased exposure of traditional hedge funds to digital assets in crypto, largely saying the change or crediting the change in the US regulatory environment as having encouraged that sort of adjustment and asset allocation in their portfolios. You see a lot of family offices and high net worth individuals also putting money in, again, often as a part of their asset allocation strategies. I also saw a report by Andreessen Horowitz saying that Bitcoin and Ethereum ETFs, exchange traded funds, held over 175 billion with a B, $175 billion at one point last year. So ETFs started being issued last year. A lot of money went in, although that 175 billion figure is probably much lower if you're going by today's prices. We've also seen a lot of adoption of the technology by large traditional institutions, things like places like BlackRock, JP Morgan, MasterCard, Visa, many others. But for those interested in immediate practical use cases, where are they looking? And again, that's stablecoins. And that's the reason why the Genius Act was a priority. And it's also why we've seen laws being passed elsewhere around the globe. And so let's turn to that. Starting in Hong Kong, the Hong Kong Stablecoins Ordinance was passed by the local legislature in May 2025, and it went into effect on August 1st, 2025. It's a comprehensive ordinance covering a licensing framework for issuing stablecoins and for stablecoin service providers. So it includes details on reserve management, redemption requirements, risk controls, governance, and gives the Hong Kong Monetary Authority, which is the central bank here, enforcement powers. And again, you hear some of the same things we heard in the Genius Act. The stablecoins must be fully backed at all times by highly liquid and high quality reserve assets and other assets the HKMA can approve on a case-by-case basis. No interest payments, no interest-like incentives are allowed, so same as the Genius Act. Redemption must be fulfilled at par value within 1 business day, so redeeming how do customers get their money back, all part of the ordinance. And earlier this week, the HKMA said they're targeting next month, March, for their first small batch of stablecoin issuer licenses. Also, in November 2025, the local securities regulator, the SFC, published circulars, on the licensing regime for crypto exchanges. The one that first came online in 2023, so it's expanding what that legislation is covering. It's now going to include products and services that can be offered by licensees, things like in other types of investment products exposed to crypto, tokenized securities, the opening of trust or client accounts, and providing custody services for a wider range of assets. There's another circulator, well, I keep saying that, another circular, which covered the integration of order books of SFC licensed platforms with those of their global affiliates to enable shared global liquidity. So it's basically just saying making local trading records compatible and connected with global records, but the platform operator has to get approval to do that. It has to be jointly managed locally and overseas. And importantly, the overseas platform must be licensed in its own jurisdiction, with that jurisdiction being a Financial Actions Task Force member with regulations substantially aligned with FATF recommendations for crypto. And we'll return to that later. But basically, you can see that there's an iterative adaptability and expansion of laws trying to make it work for the actual practical realities of business with important guardrails. In December, the Hong Kong Financial Services and Treasury Bureau, along with the SFC, also released conclusions after a consultation period about proposed regulations relating to crypto dealing and custodian providers. They said that the scope of the crypto asset dealing definition under the local anti-money laundering ordinance will be aligned with the same definition they use for traditional securities under the existing local law. So they're trying to treat crypto and traditional securities in a consistent way, even while recognizing them as separate things. There is an exception for agreements relating to yield from crypto, which is going to be treated more like derivatives, making it a different type of regulated activity. There's going to be more consultations moving forward relating to giving crypto advice and crypto management services. So really, they're trying to eventually get to a point of a comprehensive set of laws covering all sorts of crypto-related and adjacent activities. I anticipate that many other jurisdictions may look at this approach that Hong Kong has taken, this iterative approach, as a model, including maybe the approach about trying to harmonize existing securities and crypto policies where appropriate, while being clear that they are distinct laws. Elsewhere in Asia, it's been reported that Japan also looked at stablecoins and enhanced its framework for that under its Payment Services Act by adjusting its reserve requirements. So no longer must all reserves be in demand deposits. Now up to 50% can be in low-risk assets like government bonds or redeemable term deposits. So again, focus of a lot of these stablecoin ordinances is what's backing the stablecoin? Is it liquid? And what's the degree of safety of that asset? So Japan used to be fully in-demand deposits. Now it can be other low-risk assets. Some people expect that this, hopefully for them, enhances international competitiveness of Japan's issued stablecoins. And so maybe we'll see over time a coalescing of reserve requirements of major jurisdictions around the world. One place taking a slightly different approach than global trends on crypto enforcement is South Korea. Unlike the US, which is deprioritized enforcement, South Korea is intensifying its enforcement, shifting how regulators investigate and pursue market participants. Authorities have expanded probes into unregistered exchanges, offshore trading flows, and alleged money market manipulation schemes, all of which point to a more assertive enforcement agenda. The second phase of their regulatory update centers on it's called the Digital Asset Basic Act, which started circulating in various draft forms midway through last year. But the proposed legislation creates a unified framework to strengthen oversight of stablecoin issuers and foreign crypto service providers, as well as cross-border activities. It gives a lot more investigative authority to the Financial Services Commission and other regulators, including the power to demand reporting, examine foreign operators serving Korean users, and pursuing misconduct which occurs in part outside of Korea. So these developments do not merely tighten compliance requirements, but they actually expand the categories of conduct that may trigger enforcement, investigations, and potential penalties. So for investors, exchanges, custodians, ecosystem participants, there's increased significant risk coming from how regulators interpret trading activity, liquidity movements, or governance decisions, even in hindsight. Lastly, in the UK, in December 2025, the Property Digital Assets, etc. Act became law. This followed a long project involving consultations and reports by the Law Commission, which ended in this new legislation. the act makes clear that digital assets, crypto assets, are property, even if they don't fall into technical, classical categories of types of property. And really, this is, the types of things that, common law lawyers will spend a lot of time debating in school. But this is more than just academic. The practical effect is that it confirms, frankly, what had already begun to be seen in common law courts in England and in other jurisdictions, which is that traditional proprietary remedies can be used in relation to crypto or digital assets. So things that are like tools that are used for freezing assets and seizing assets and recovering fraudulently stolen assets can now be applied in the same way, at least as a matter of law, maybe not as a matter of technical use, to crypto. So this is just another example of laws and regulations being given more clarity after some years of debate and analysis. Moving to combating crime that's related to crypto. Perhaps the most important challenge, and maybe most relevant in various ways to the work of Fintelekt members, is combating such crime, including preventing the laundering of criminal proceeds by crypto. So according to Chainalysis, crypto crime has become increasingly professionalized, with illicit organizations operating large on-chain infrastructure to help transnational criminal networks procure goods and services and launder ill-gotten crypto. Also, nation states are moving into that space as well, including for sanctions evasion. So Chainalysis has said that, quote, government agencies and compliance and security teams now face significantly higher stakes on both the consumer protection and national security fronts. On the nation state side, Chainalysis points to hackers linked to North Korea stealing $2 billion, including $1.5 billion last February 2025, relating to what's called the Bybit exploit. Chainalysis notes, quote, although North Korean hackers have long been a fixture on the threat landscape, the past year has been their most destructive yet, both in value stolen and in the sophistication of their intrusion and laundering tactics. One example of a large transnational criminal network received a lot of attention late last year. Multiple jurisdictions brought allegations against the Prince Group and its purported founder, Chen Zhi, who was accused of running a vast cryptocurrency scam that used trafficked workers in forced labor camps in Cambodia to defraud victims globally under what's been known as investment scams or pig butchering scams. Allegedly, this was a very lucrative scheme. Reportedly, one of Chen's accused co-conspirators said that in 2018, they earned more than $30 million in a day from these activities. Now, last October, the US charged him with running these scams and alleged it had the scams had stolen billions of US dollars in crypto. The US said it also had taken custody of 127,271 Bitcoin that allegedly were proceeds of the defendant's fraud and money laundering. Now, last October, that was worth 15 billion billion with a B, making it the largest forfeiture action in the history of the US Department of Justice. Again, that valuation is going to be materially lower at today's prices. Still very significant. The US, UK, and South Korea sanctioned his group, the Prince Group. Cambodia suspended the operations of Prince Group's subsidiary, Prince Bank. Hong Kong froze 54 million that were linked to Chen and his group, comprising cash, stocks, and funds alleged again to be criminal proceeds. Thailand seized $300 million relating to this. Taiwanese authorities detained nearly $150 million, and as well as cars, properties, bank accounts, also detained 25 people. Singapore seized $120 million as well. Then on January 6th, Chen was arrested in Cambodia and extradited to China to face investigations there. So truly a global alleged crime, and it was met with a truly global law enforcement response. Also, as many will know watching today, one of the leading global voices on combating financial and crypto crime, particularly from the anti-money laundering and counterterrorism angle, is, of course, FATF. They, too, had updates to share this year. Just as a reminder, it was in 2019 that the task force extended its global standards on AML CFT to apply to crypto, or what it calls virtual assets and virtual asset service providers. Subsequently, it's released periodic updates on adoption by various jurisdictions to those standards. Its latest update was in June 2025, and then they said that there had been some improvement with things like regulatory development and enforcement actions, including improvements on licensing and registration regimes, but also that challenges remained still in licensing matters elsewhere, as well as enforcement needs and offshore hurdles. Specifically, the task force urged jurisdictions that had not yet done so to identify and assess the money laundering risks associated with crypto or virtual assets, as well as service providers, and to then implement mitigation measures. So, for example, ensuring full implementation of its recommendations on licensing and registering service providers, on identifying natural or legal persons that conduct such activities. So that's for enforcement purposes. To consider what to do with stablecoins and what to do with offshore virtual asset service provider activity that reaches onshore. They said that 85 out of 117 jurisdictions, which is 73%, have implemented the travel rule via legislation. So again, people said that that's among the things that have affected them this year, and that's the rule requiring information sharing across relevant entities involved in a transaction. The task force encouraged even those that have introduced this rule to operationalize it with effective supervision and enforcement. So it's not just enough to introduce the rule, but you got to make it effective and supervise it. For those involved in supervision, it directed folks to its best practice on this for further guidance. They have a best practice paper that I'll mention again shortly. Also on decentralized finance, or DeFi, FATF said that remains a challenging area, right? Less than half of the jurisdictions that are already more advanced than others in regulating VASPs are requiring certain DeFi arrangements to be licensed or registered as a VASP. So a lot of jurisdictions started with licensing regimes for centralized crypto service providers, right? There's actually a company or a business that's set up, that business needs to be licensed, et cetera. Even those jurisdictions that are doing relatively well in that process, FATF is saying it's still a challenge for those jurisdictions as well as other jurisdictions to deal with decentralized finance. There's not a centralized company, or purportedly there's not a centralized company or platform that is taking in customer due diligence information, et cetera. So what do you do then? How do you make sure that these recommendations can apply effectively to them? It also had recommendations for the private sector in light of all these threats. So private sector should ensure they have appropriate risk identification and mitigation measures, including money laundering risks and rules identifying that, customer due diligence, travel rule, risk mitigation measures to hacks, frauds, scams, all the things that we've been discussing. And again, pointing private sector actors as well to its June 2025 best practice in travel rule supervision for further guidance. So you can find that on their website. I imagine that might be a relevant area to many online today, so please check that guidance if you haven't already. And then lastly, with trends, and then we'll open it up to questions. Consistent with my prediction last year, many major jurisdictions have addressed centralized crypto exchanges or payment services licensing, stable coins. Those that haven't will be rushing to deal with those. Then the next wave will be laws and regulations on custody of crypto and real world asset tokenization, because those are frankly the things that people are working on and building out presently. We're going to see consistent developments across jurisdictions on those fronts. I say consistent, meaning it will keep happening. I'm sure the pace will be inconsistent, and we'll see how consistent or not consistent the actual details of the laws and regulations are. But on that point, will there be a work towards harmonization globally, or is it going to be some kind of race to the bottom in terms of what's the easiest regulation to fulfill? And if so, how do other jurisdictions look at that jurisdiction in terms of mutual recognition or lack of mutual recognition? Finally, I think a big issue is going to be crypto's intersection with artificial intelligence. Obviously, AI is the tech buzzword that has supplanted crypto over the last year or more. I think there's a downside view, which is one of, just taking one example, you could have AI trading crypto with AI on the other side. Now, algorithms already do this, but this can be tremendously amplified. What if there is some inadvertent AI hallucination that causes some significant impact on financial markets? As I said at the outset, now that traditional markets and institutional players are more intertwined with crypto markets, could a major negative event in the crypto markets, perhaps fueled by AI, spill over more into traditional markets now? On the plus side, or a more optimistic vision, could the marriage of the two tech developments solve each other's downsides, right? So for AI, often we're worried about trust, authentication, what's real, what's fake. But blockchain technology, with its immutability and transaction transparency, can potentially help with the authentication piece, right? So that's a potential use case for the technology. Also, AI might be useful support for crypto KYC and compliance as the number of transactions go up. Obviously, we don't want to put folks out of a job. Every industry is worried about that, but can we use it in a way that's useful as a tool to support those efforts, transaction monitoring and otherwise? But if we do, how do we make sure that AI is trained properly and avoiding biases and still accountable for errors, things like that? So I'll leave it there as a cliffhanger for next year. I think we have another poll, and then we can open it up for questions. Thank you.
Thank you so much, Calvin. I can see the amount of effort that went into summarizing all of those developments into a half-hour capsule. So thanks very much. And while we wait for attendees to add their questions into the Q&A box, there's another poll that we have launched on expectations from 2026. And while our attendees are answering that, Calvin, my personal observation was that there were perhaps relatively lower crypto failures in 2025. And I'm not referring to the hacks, but the actual failures of the type of FTX or, Terra Luna. Do you think that the maturity and overall evolution of the industry is now leading to more stability, amongst virtual asset service providers? What is your view?
Yeah, I think it's definitely a maturing industry, but I think the maturity is going to align it more like traditional finance in the sense of there will still be some collapses every now and then. The prices and the investments that we're seeing over the last day and weeks could affect negatively some of those businesses. I guess the hope is that these are based on business judgment decisions that went wrong, as opposed to, say, the FTX, which was then revealed to be a fraud. And I know, for example, some of the other cases that I've dealt with a few years ago were also built on fraud. That's not to say fraud hasn't disappeared from traditional finance either. Those cases still exist. But I think it will be more similarities can be drawn in those types of what's causing failures than what we saw a few years ago.
Right. Thanks. Team, can we close the poll and please show us the results? What do you expect will be your biggest crypto-related compliance challenge in 2026? And we have effective transaction monitoring and typology detection. Calvin, that seems to be of concern. Around that, the FATF update that you spoke about, it speaks about increased financial crime risk from stable coins, and that I think is one large takeaway for me, from the happenings in 2025. But is there, a trade-off between stable coins reducing the volatility risk, but actually increasing the financial crime risk because of its, inherent ease of transfer?
Yeah, I mean, that's definitely sort of the double-edged sword or double-edged part of stable coins. You're right about well, I guess a couple of things. There's less volatility in terms of the value, or at least what's seen by the market as the value. When I talked about a lot of the reserve requirements, the story behind a lot of major stable coins is can the consumer actually trust that if there was some kind of collapse, I could go and get my money back, right? So what's actually backing the stable coin? A couple of years ago, there was, some of you might have followed the news about Luna, right, which was an algorithmic stable coin. So it's based on an algorithm that was supposed to be able to ensure that the value maintains stable. So a lot of these ordinances say you can't have an algorithmic stablecoin, or they're not going to issue licenses for that. It has to be a stablecoin that is backed by dollars or fiat currency or low risk treasuries, right? So you're solving that problem, but then maybe encouragingly, the use of stablecoins has shot up. Maybe it's fueled by, hey, I feel good about that these things are backed. I'm going to use it more for my business, cross-border businesses, the settlement time is quicker, the transaction fees are lower, but then yes, the increased adoption of that then means if something does go wrong, and which these laws are trying to mitigate the risk of that, but if something does go wrong, are the guardrails up? Is the market willing or able to, withstand those collapses? So remains to be seen. There is concern about that, and the governments are sort of balancing between producing laws and guidance that allow the adoption while mitigating the downside risk.
Sure, thanks. And on cross-border sort of investigations and your area of work, are you now seeing greater cooperation among regulators while investigating crypto-related financial crimes? Is that also on an uptick?
Yeah, I think that Prince case example is a major one. Now, of course, it may take sort of the eye-popping numbers that you see in some of these cases to really get so many jurisdictions to prioritize it. But again, this isn't that different than traditional finance either. I think you are seeing in a positive way that more and more jurisdictions have teams that are very knowledgeable in these types of crimes and offenses. So going back a few years, a lot of jurisdictions didn't have people who understood what's going on, how to trace the assets. That's changed. And with that, that means there's a greater ability for law enforcement in different jurisdictions to cooperate. So when it reaches a certain level, I think you do see that cooperation.
Right, right. I would agree with that based on our discussions with regulators around the area. There are two questions in the Q&A box that I'd like to take at this point. One is by Mig Moreno from the Asian Bankers Association. It's a quick question. Are regular banks asking for opening accounts for BTC?
I don't know, maybe others can type in and see if they've seen it. I still think the link between traditional banks and cryptos is still more on the technology adoption side, like traditional banks saying, hey, how can we use blockchain technology for our own products and services, and maybe even their own stable coins, and less on holding deposits in BTC or others. There are some financial institutions and brokerages that are doing that around the world. But I think when you think about the biggest banks, they're more interested in the technology part and then having their own coin versus simply being a repository or holding the custody of crypto, because they don't want necessarily the risk that comes with that.
Sure, sure. There's a question by Sushmita Maru. What mechanisms are being used to ensure that stablecoin issuers maintain adequate reserves? And how transparent are these disclosures to the public?
Yeah, great question. And so that's top of mind for a lot of these laws and ordinances. So what seems like to be a popular choice for regulators is to require, so not only that the issuer then hold the treasuries and the dollars, but how do you prove that, to your point, to the question? So they have to get those audited, and those are then released at some periodic period. Maybe some might say monthly, some might say quarterly. It also has to be signed off by senior officers of the issuer. So that puts sort of individual liability on the leadership. So such that if there was something went wrong, if those were not truthful, then a government can go after that person. So on top of that, a lot of these licensing regimes require that there be a senior person physically present in the jurisdiction. Because what's the point of having an individual liable if that person is half the world away in a place that you can't actually touch them? So these are sort of the guardrails that a lot of ordinances are putting up. I guess it wouldn't be a counter argument, but the comments that would come back from legitimate businesses trying to do that is, if you're a legitimate stablecoin issuer, do you need a senior executive in literally every single jurisdiction in which you do business? Because that may not be practical. Also with the reserve requirements, do I need to have those reserves in every single jurisdiction in which I do business? Also potentially not practical for the business. But you can see how the government, whose priority would be their own citizens, would say, well, we need to protect our citizens first, otherwise you can't come in. So there is a potential, there is a tension there and a need for some resolution on how to make that work best in practice.
Right. There's one question by Dr. Surya Bahadur Singh on whether central banks in Southeast Asia will allow crypto transactions directly. I think where he's coming from is that there are bans in place currently in several jurisdictions in Asia. Are they coming with central bank digital currency and tax regulations? Do you have any idea about regulations in some parts of Asia?
So I don't, unfortunately, know the finer details of that. I think what you do see in a lot of central banks, probably around the world, is that they are concerned about the lack of control they have for these types of coins if it's not the ones that they issue, right? Both in terms of monitoring, maybe there's capital controls in a jurisdiction, which makes it harder to monitor if it's something outside of their control. So they have to balance that against maybe what their economy needs. Like if truly it turns out that a substantial part of global transactions move onto stable coin rails, then they can't just completely ignore that. Otherwise, you're missing out on a big part of the global financial and payment systems. But at the same time, is it consistent with your domestic capital control needs, monitoring needs, et cetera? So that is something that a lot of jurisdictions are having to navigate.
Right. And the question by Neil Rasaya. Neil, great to see you online. Neil is from Sri Lanka. What are some of the areas that a jurisdiction trying to start regulating crypto trading should look at?
So it seems like the global approach has been starting with the centralized exchanges, right? Because that, by volume, if you think there's so much to cover, well, where do we start? The exchanges are typically the places that have the highest volume and the places that retail customers face the most risk, right? So maybe it's one thing for sophisticated professional investors to make their own decisions on how they and where they want to trade. But whether because of social media trends or just hearing it around the dinner table, oh, some asset, some crypto is exploding. How do I get that asset? I can easily create an account on this exchange and buy and sell. That's where grandma runs into trouble and loses her money. So a lot of jurisdictions start with that because they're protecting the most vulnerable citizens in their jurisdiction. And then second, it seems like stablecoins is the next priority just because of its large use case that's growing and growing. So starting and prioritizing the areas that protect the most vulnerable and are the areas in which there is the most use and growth. And then you get to the other areas as the industry expands in a relevant jurisdiction.
Fantastic. I think we are at the end of time. And Calvin, this has been absolutely fantastic. Thank you so much for all the effort that you've put into this. and for all the expert insights that you shared. I'm sure it has been, very, very useful for all our attendees. Thank you so much to all the attendees for spending this hour with us and learning more about crypto. Fintelekt, as you all know, is a specialist AML CFT training company. So if you have any training requirements on AML, please feel free to contact us at any time. And thanks very much, and have a great day ahead and a great weekend ahead as well. Thank you. Thanks, Calvin.
Thank you, everybody.